Welcome to the deep dive. We heard you loud and clear. You wanted us to really dig into what's going on with Tractor Supply Company, TSCO, specifically, their Q3 2025 results.
Yeah, it's more than just numbers, isn't it? We're looking at a major player in rural retail, and they're making some big bets on the future.
Absolutely. So our plan today, our mission, if you like, is pretty straightforward. First, a quick check on the financials. Spoiler, they look pretty solid.
Right. And then we pivot fast to the really interesting stuff. How are they actually changing that whole life out here idea? We're talking new strategies, things like direct sales, even artificial intelligence.
Okay, let's kick off with that headline number because it does set the stage. TSCO hit a record for Q3 net sales, $3.72 billion. That's up a healthy 7.2% from last year.
Which is strong, yeah. But the number that really caught my eye, and probably yours too, was the comparable store sales growth.
Exactly, 3.9%.
Yeah.
I mean, considering they had a decline of 0.2% the year before, that's quite a turnaround.
It really is. It suggests they're definitely grabbing market share, especially in those core everyday items. But, we should probably unpack that 3.9% a little bit more.
Agree. Let's get into the Q3 financial health check properly.
Okay, so that 3.9% comp figure,
Mm.
how did they get there? Was it just prices going up, or were more people actually walking in?
Good question. And the answer seems pretty encouraging. It looks like, well, balanced growth.
Good.
So the 3.9% comp increase, about 2.7% of that came from more comparable transactions. So yes, more foot traffic, essentially.
Get it. More people shopping.
And the other 1.2%, that was from a higher average ticket size. So a bit of both, but tilted towards more customers, which feels, healthier.
Definitely. And it wasn't just one region carrying the load, right?
No, that's the other key takeaway. They saw positive comps across all their geographic areas. And get this, in 11 out of the 13 weeks of the quarter. That's pretty consistent performance.
Okay, so the top line looks good. Sales are moving. What about profitability? You mentioned gross margin looked okay.
Yeah, gross margin actually expanded a bit, up 15 basis points to 37.4%. That shows some real discipline on the cost side, especially when you think about supply chain pressures.
Right. Things like tariffs, higher transport costs. They managed to absorb those pretty well, it seems. Good cost management on the product side.
And there's always a but. The operating margin actually went the other way. It dipped slightly, down 14 basis points to 9.2%.
Okay, so SG&A deleverage, that sometimes makes investors nervous. Are they just spending too much?
Well, that's the million-dollar question, isn't it? Management's take is that this isn't out-of-control spending. It's very deliberate, strategic investment.
Investing in what specifically?
Three main things driving that SG&A increase. First, the planned costs of rolling out those big new initiatives like the direct sales program we'll talk about.
Okay, planned investments.
Second, yes, higher incentive compensation, basically bonuses. But the reason those were higher is because the teams actually beat their performance targets.
So paying for performance, not necessarily a bad sign.
Exactly. And third, it was a bit of an accounting thing. They got less benefit this year compared to last from their sale leaseback deals on properties.
Right, so less of a tailwind there. So the story they're telling is performance was good, we rewarded our people, and we're investing hard for the future.
Pretty much sums it up. And even with that spending, the bottom line held up. Diluted EPS was still up 8.6% to $0.49.
Okay, solid foundation then.
Right. So financials seem robust enough. Let's shift gears. Who was buying all this stuff, and what were they buying? What did they see from the consumer?
It sounds like it tracked pretty closely with the broader U.S. picture. A strong start to the quarter. July and August were good.
Okay.
But then things kind of moderated a bit moving into September. People feeling a bit more pressure, maybe getting a little more cautious, especially on the bigger purchases.
Classic discretionary pullback.
Right.
And of course, you can't talk about Tractor Supply without talking about the weather. The old bathtub effect, as you called it.
Ah, yeah, it really fits here. They definitely benefited from what they termed an extended summer season. Meaning warm weather lingered, pushing demand for certain summer-related items later than usual. They estimated it added maybe 50 to 60 basis points to Q3 sales. Stuff that might normally have sold in Q2 got pushed into Q3, and they were ready for it.
So a nice little tailwind from the lingering warmth. But weather cuts both ways, right? What were the headwinds?
September was the flip side. That unseasonably warm weather delayed the start of fall and winter prep buying. Heaters, insulated gear, things like that.
Okay, delayed seasonal sales. Anything else?
Yeah, a big one, actually. They had a tough comparison because Q3 last year, 2024, got a boost from hurricane-related emergency sales.
Ah, generators, tarps, cleanup supplies.
Exactly. This year, thankfully, was quieter on the storm front, but that lack of emergency buying created a headwind compared to last year.
Makes sense. So given that push and pull, what product categories really shone through? What were the winners?
No surprise here, really. The core strength, as almost always for TSCO, was in their CUE categories.
Consumable, usable, and edible. The everyday necessities.
Precisely. Livestock feed, poultry supplies, pet food, wildlife feed. This is the stuff their core customers need, consistently. It's almost like a subscription business in some ways.
And those performed well.
Very well. Mid-single-digit comparable sales growth in those core CUE areas every single month of the quarter. That's what provides the stability.
Okay, so the necessities were strong. Did anything surprise you on maybe the bigger ticket side? I thought the consumer was cautious there.
They were generally, but some things still did well. Tractors and riders, especially zero-turn mowers, had a strong quarter. They actually gained market share there.
Interesting. So the core doing work around the property customer was still spending.
Seems like it. And they also made strides in wildlife supplies. They launched that Field and Stream brand partnership, nearly 50 new items. That helps position them more as a destination for that broader outdoor lifestyle.
Okay. And the ones that really struggled, the laggards.
Pretty much what you'd expect given the cautious consumer and the lack of storms. The really discretionary stuff, think recreational vehicles, high-end grills, gun safes, and generators because of that lack of storm demand we mentioned.
So CUE and essential tools carried the quarter, while the nice-to-haves took a back seat.
That's a good summary, yeah.
All right, let's dive into those strategic investments then, because that seems to be where the real story is heading. And it all starts with the customer, right? That loyalty program sounds incredibly strong.
It really is the bedrock. The Neighbors Club, it accounts for over 80% of their sales now.
80%.
Yeah. And in Q3, they hit record highs for total members, retention rates, the whole package. Plus, they mentioned 17 straight quarters of improved customer satisfaction scores. That's just phenomenal consistency.
You don't build that kind of loyalty overnight. Okay, so leveraging that base, let's talk about this direct sales initiative. Targeting the big barn customer, they call it. Sounds intriguing.
It is. Think large farms, professional landscapers, maybe serious equine operations, customers with complex, high-volume needs.
So not your average backyard chicken keeper.
Right. And the approach is different. They're hiring dedicated specialists, people who often have like 10 years of experience in that specific industry, farming or equine, whatever it is. They live the lifestyle.
So they can talk the talk.
Yeah.
Not just read a spec sheet.
Exactly. And it seems to be working. They've got 48 specialists covering over 300 stores already. And they said the initiative is beating expectations and should actually pay for itself, self-fund by 2026.
Wow. And the sales numbers from these customers are huge, right? The average ticket is like 7 times the normal store average?
Yeah, roughly 7 times, because these aren't small purchases. It's bulk feed, large equipment, extensive fencing, complex veterinary supplies. You name it.
I see.
These specific big barn customers are apparently comping close to 50% higher year over year. The whole program is bringing in over $200,000 a week already.
Okay, that justifies having dedicated experts focused just on them. Makes total sense.
Yeah, it's hyper-targeting a very valuable segment.
All right, let's shift to digital. We hear a lot about retail media networks from, the Amazons and Walmarts, TSCO's building one too. How significant is that for them?
I think it's potentially huge, actually. It's easy to overlook, but they're projecting triple-digit growth in their retail media revenue this year, 2025.
Triple digits. Okay, what exactly is retail media in their context? Selling banner ads on their website.
It's more sophisticated than that. It's basically allowing their suppliers, the brands they sell, to buy targeted advertising placements within Tractor Supply's own digital ecosystem.
Ah, so reaching that super loyal Neighbors Club member directly when they're already shopping or browsing on the TSCO site or app?
Exactly. It's high-value placement for the vendor. And for TSCO, it's a high-margin revenue stream that leverages the customer base they've already built. They mentioned an 80% increase in the number of vendor partners participating and nearly 50% growth in what the average partner is spending.
So it's becoming a real business line, not just a side project, monetizing their digital traffic effectively.
Precisely. Very smart way to leverage that loyal audience.
Okay, and now for the really techie part, AI and automation. They mentioned 3 buckets. Can you break those down? Let's start with the custom stuff. Tractor Vision, Corso. What are these?
Right, so bucket one is just using AI features built into software they buy from vendors, fairly standard stuff. Bucket two is these custom-built apps. Hey Gura sounds like maybe an internal communication or knowledge tool. Corso is likely for task management, helping store teams track what needs doing.
Okay, operational tools.
And Tractor Vision probably uses some form of a computer vision, image recognition, maybe for checking inventory on shelves or assisting customers. They're designed to automate specific routine tasks in the stores or DCs.
Got it. Streamlining operations. But bucket three sounds like the most advanced enterprise integration with OpenAI.
Yeah, this is where it gets pretty cutting edge for retail, especially this kind of retail. They have somewhere between 1,200 and 1,500 people with enterprise OpenAI access linked directly into their main company data lake.
That sounds complex. Integrating that kind of AI with all their operational data,
Yeah.
inventory, sales, customer feedback. What's the big win they're seeing from that?
It's definitely not a simple plug and play, but the potential payoff is huge efficiency gains. They gave a really concrete example involving their fast teams.
Right, the field administration and support teams.
Hmm.
The ones who go into stores and do major resets, like changing the layout of aisles, the planograms.
Exactly. And as you know, a planogram is super detailed. This product goes here, facing this way.
A vital but tedious part of retail execution.
Totally. And traditionally, after a fast team does a big reset, they take photos, send them off, and some manager has to manually check every photo against the planogram to make sure it's right. It takes forever.
Okay, I can see how that's a bottleneck. So how does AI help?
Well, now they use an AI system, likely leveraging that OpenAI integration and computer vision to analyze those photos instantly. Yeah. It checks the photo against the digital planogram. Is the shelf tag right? Is the product in the correct spot? Is it stocked correctly? It gives immediate feedback right there to the team member in the store.
Wow.
And it only flags the real problems, the things that actually need a human decision, up to the manager. So the manager isn't bogged down checking hundreds of correct photos. They're dealing with the exceptions and coaching.
That frees up a massive amount of time and speeds up the whole reset process. That's a very practical, high-impact use of AI.
It really is, using advanced tech to solve a very real-world operational headache.
Okay, that AI example is genuinely impressive, especially for a, traditionally boots-on-the-ground kind of retailer.
Yeah.
So looking forward, they took all this Q3 strength and the investment plans, and they narrowed their guidance for the rest of 2025.
They did. Shows a bit more confidence and visibility. They're now guiding full-year net sales growth between 4.6% and 5.6%, and diluted EPS between $2.06 and $2.13.
And what about the current quarter, Q4?
The outlook there is still pretty wide. Comparable store sales between +1% and +5%. And they were really clear about why it's so wide.
Let me guess. Weather.
You got it. They basically said Q4 performance hinges almost entirely on winter weather patterns, much more than holiday shopping, actually.
Right. A cold snap drives sales of heaters, feed, engine block heaters, all that stuff.
Exactly. They said historically, the timing and severity of the first real cold snap is the biggest single factor determining Q4 results. If it's early and sustained, they do great. If winter arrives late or is mild, it's a drag. High volatility.
So Q4 is a bit of a weather bet. But let's look beyond that to 2026. They're framing that as a key year, right, when these investments really start to mature.
That's the plan. They called 2026 potentially a more normalized year. Part of that is accelerating physical growth again. They plan to open 100 new stores, up from 90 this year.
100 new stores. Where are they expanding?
Seems like broad-based growth, but they specifically mentioned pushing further west, helped by a new distribution center they're opening in Idaho.
Okay, expanding the footprint. And financially, 2026 is supposed to be the year margins start improving again, the inflection point.
That's the expectation. They believe they'll be past the peak spending phase of these big strategic investments.
So the heavy lifting on cost is done, relatively speaking.
Right. And the idea is once comparable sales growth gets above the low 2% range, they should start seeing operating margin expand again. Those efficiencies from direct sales, retail media, the AI stuff we talked about, they should start flowing through to the bottom line more noticeably.
And they expect sales growth to be driven by?
They think transactions, meaning customer traffic, will continue to be a strength, and the average ticket should also stay positive. So yeah, 2026 is positioned as the year things get back to a more balanced growth and profitability improvement story. #tag outro.
Okay, so let's try and wrap this up. The key takeaway for you, our listener, seems to be this. Tractor Supply navigated Q3 well, leaning on its essential products that CUEV base during a tricky time for consumers.
Right. But critically, they didn't just tread water. They used that stability to aggressively fund these big future bets: direct sales, retail media, AI.
Which sets them up potentially for a return to more consistent growth and better margins starting in 2026, assuming those investments pay off as planned.
Exactly. It's all about strengthening their position, their competitive advantage, making that promise. Out here, lifestyle solutions, anytime, anywhere, anyway, actually means something tangible through these initiatives.
Which brings us to our final thought for you to chew on. We just talked about some pretty sophisticated tech enterprise AI linked to data lakes, custom computer vision apps, analyzing store shelves.
Yeah, not typically what you associate with selling feed and fencing.
Right.
Yeah.
So here's the question. How quickly could the digital and tech sophistication of a focused niche retailer like Tractor Supply actually start to significantly outpace bigger, more general competitors, maybe your Home Depots or Walmarts, in serving their specific customer base?
It's an interesting thought. Will that highly specific application of advanced tech in a, let's say, traditionally lower tech retail space become a more powerful advantage than just sheer scale? Something to watch.
Definitely something to think about. We've laid out the data and the strategy. Now it's over to you. We'll catch you next time on the Deep Dive.